Today, we're breaking down unit trusts, what they are, how they work in South Africa, and how they fit into your investment strategy. If you've searched, what is a unit trust, how do unit trusts work, or is a unit trust right for me, then you're in the right place. So, what is a unit trust? The simplest way to picture it is this. Imagine a giant shopping basket filled with investments. Instead of buying each item yourself, shares, bonds, property, offshore assets, a group of investors all chip in and a professional manager fills the basket on your behalf. That giant basket is the unit trust. Your money becomes units in that basket. If the investments inside grow, the value of your units grows too. Unit trusts are designed for people who want diversification, professional management, and simplicity, without having to pick shares or track markets every day. Is a unit trust right for me? Before we go any further, it's worth pausing on a really important question. Is a unit trust right for me, and will it actually help me achieve my investment goals? Unit trusts are best suited for medium to long-term investments and those seeking flexibility. For example, if you're building wealth outside of retirement products, saving for something 5 years or more away, or you want the option to access your money if plans change, a unit trust can be a good fit. There are also cases where a unit trust might be okay, but not ideal. If your time horizon is short, say 1 to 3 years, market ups and downs can work against you, and that risk might not be worth it. If you're investing specifically for guaranteed income in retirement, or tax efficiency matters to you, other products like retirement annuities or a tax-free savings account might make more sense. So the takeaway is simple. Unit trusts are about flexibility and growth, but they work best when they match to the right goal, time frame, and risk tolerance. So how does a unit trust actually work? A unit trust pools money from many investors. A professional manager invests that pool into a mix of assets, equities, bonds, property, offshore exposure, or often a blend of all of them. That pool is divided into equal slices called units. The price of a unit, the net asset value, reflects the value of everything the fund owns. You buy the units, the fund invests, and your units increase or decrease in value as the underlying investments move. How do unit trusts pay out? Some unit trusts pay out income, usually interest or dividends, and that gets distributed to investors. Others reinvest that income automatically, so your investment grows faster. It depends on whether the fund is income-focused or growth-focused. If you sell your units after they've appreciated, you will make money, although bear in mind that growth will be taxed. Can I withdraw money from a unit trust? And the answer is yes. Unit trusts are extremely flexible. You can withdraw whenever you need to, either partially or fully. With 10x, there are no minimum withdrawal amounts. It's your money and you can access it at any time. Just remember, withdrawing early affects your long-term returns because your units stop compounding the moment you sell them. So how much does a unit trust pay? The truth is, there's no guaranteed return. Unit trust performance depends on the assets inside the fund, equities, bonds, offshore exposure, and so on. For example, long-term growth funds have historically delivered higher returns than income-focused funds, but they also come with more short-term ups and downs. What many people often overlook is fees. Even small fees can quietly eat into your returns over time. That's why it's important to check the fund's effective annual cost, or EAC. It shows you the real, all-in cost of owning the investment. Choosing a fund isn't just about returns, it's about what you keep after fees, and whether the risk and time horizon makes sense for you. Do you pay tax on unit trusts in South Africa? Yes. While the money you invest isn't taxed, any interest, dividends, or capital gains you earn will be taxed. Unlike with a tax-free savings account, unit trusts don't have tax-free growth, so you need to factor taxes into your long-term returns. So why do people choose unit trusts? Because they're simple, flexible, diversified, and professionally managed. You don't need to pick shares yourself or track market movements every day. And because your money is spread across many investments, the risk is lower than buying 1 or 2 shares on your own. Are unit trusts risky? The short answer is that all investments carry risk. But with unit trusts, you're able to choose how much risk you take. They are conservative, balanced, and higher growth funds, and the right choice depends on your time horizon and how comfortable you are with the ups and downs of the market. Something that is worth mentioning here is how risk can differ between actively and passively managed unit trusts. Passive funds typically track a market index, so their risk closely matches the market itself. Active funds, on the other hand, can take more or less risk depending on the manager's decisions. Sometimes that extra risk pays off, but often, especially after fees, it doesn't. The key takeaway is this: match your unit trust not just to the returns you want, but to the level of risk you can realistically stick with. Unit trusts and mutual funds. In South Africa, these two terms mean exactly the same thing. There's no legal or practical difference. Both are regulated collective investment schemes. Internationally, the terms may differ, but here they're interchangeable. So how much does a unit trust cost? Unit trusts usually have 3 layers of fees: a management fee, a platform or admin fee, and sometimes an advisor fee if you use one. And here's the important part: fees compound just like returns do, only against you. Over many years, even a 1% fee difference can take a huge chunk out of your investment. That's why fee transparency is critical. You should know exactly what you're paying, with no hidden performance fees or confusing layers of charges. At 10x, low, transparent fees are a core part of our investment strategy. The less you pay in fees, the more of your returns stays invested and compounding for your future. So what type of unit trusts are available? Investors also ask, what types of unit trusts are there? There are growth funds, income funds, defensive funds, offshore funds, balanced funds, lots of funds, each with a different goal and risk level. The key is choosing yours based on your time horizon and risk profile. A useful rule of thumb could potentially be the following. For short-term investments, look at income or more defensive funds. For medium-term investments, look at moderate funds. And for long-term investments, consider high-growth funds like equity or balanced funds. Unit trusts and ETFs. People also compare unit trusts versus ETFs. ETFs track an index and trade on the stock exchange. Unit trusts don't trade on the JSE. You buy them directly from the provider, and they can be actively or passively managed. In short, ETFs are great for low-cost passive investing, while unit trusts give you more flexibility in structure and fund type. How to choose the right unit trust. Start with these 4 questions. What's my time horizon? How much risk am I comfortable with? What fees am I paying? And what are the provider's 5-year returns? If you're investing for the long term, growth funds usually give the strongest outcomes. If you need stability or income, defensive funds may make more sense. Are unit trusts good for short or long-term investing? People often ask whether unit trusts are better for short-term or long-term investing. And the answer is both, depending on the fund you choose. Income funds work well for shorter time frames. Growth funds work best for longer time frames because they need time to weather market cycles and compound effectively. Okay, so what to do next? If there's one takeaway from all of this, it's this. Unit trusts aren't about chasing the best fund or the highest headline return. They're about making simple, sensible investment choices that match your time horizon, your risk tolerance, and your goals. And then letting time and compounding do the heavy lifting. Always know what you're investing in. Always check the fees, especially the EAC. And choose a fund that fits your life, not someone else's.